Hey everyone, today we're exploring one of the most fascinating and useful topics for traders, Elliott Wave Theory. As you might know, markets move in cycles. Financial expert Ralph Elliott first introduced this concept and created the theory we're exploring today. So, what is Elliott Wave Theory? It's a concept that suggests markets move in predictable cycles. Essentially, it's the alternation of growth and decline periods which can be broken down into specific phases. The theory, developed in the 1930s, is still highly relevant in the stock and crypto markets. Wave analysis revolves around specific patterns often called waves or cycles. These waves are a result of mass psychology. The patterns are divided into two types: impulsive and corrective waves. Impulsive waves move toward the main trend, while corrective waves move against it. The chart forms a wave structure consisting of 5 impulse waves and 3 corrective waves. Let's break down these waves in more detail. The creator of the theory outlined 5 main waves that make up a complete market cycle. Wave number 1, the initial growth, often the weakest, but it kicks off the trend. Wave number 2, a correction where traders who jumped in on the first wave lock in their profits. Wave number 3, the most powerful. This wave carries the most vital trend movement. Wave number 4, a correction before the final push. Wave number 5, the trend's completion, usually followed by a significant correction. After these 5 impulsive waves, there are 3 corrective waves. They signal a pullback after the primary trend. This is where you need to be extra cautious because they often hint at potential exits or even trend reversals. You're probably asking, how can I use this in practice? Elliott Waves helps us spot entry and exit points and even predict future price movements. For example, if you notice Bitcoin or Ethereum forming a series of waves and see the third wave starting, this is a strong buy signal. Moreover, corrective waves often indicate when it's time to lock in profits. If you spot that the market has peaked during the 5th wave, be ready for a correction. Let's look at a concrete example. On the Bitcoin chart for several months, we see a classic wave theory model. A correction followed the first impulse wave. The third wave was the most powerful, followed immediately by a correction wave. The 5th, in turn, completely ends the impulsive movement and signals the beginning of a longer correction, which you can see on the chart. This is a perfect movement for traders to analyze and prepare for the next moves. If the 5th wave turns out to be weak, expect a sharp pullback or even a trend reversal. These wave patterns have many variations, so analyzing each chart individually is essential. Elliott Wave Theory isn't just an analysis tool, it's a way to understand market psychology. Each wave reflects trader behavior, their fears, hopes, and desire to make profits. By recognizing these patterns, you can predict their actions and use this knowledge to your advantage. This theory works particularly well in the cryptocurrency market, which is highly influenced by psychology and volatility. The more dynamic the market, the more waves we see. Let's sum it up and highlight some key points on how to use Elliott Waves. Wave number 2 never rolls back further than the starting point of wave number 1. Wave number 3 does not have to be the most extended wave, but it is almost always the longest wave. This wave may not be the shortest of the momentum waves. Wave number 4 cannot go beyond the peak of wave number 1. Also, there are several rules. Number 1. Combine Elliott Waves with trend indicators. Use Elliott Wave Theory alongside traditional indicators like moving averages or RSI. For instance, if the third wave starts forming and RSI shows overbought conditions, be prepared for a correction. This adds confidence to your analysis and helps avoid mistakes from false signals. Number 2. Apply the theory across different time frames. One of Elliott Wave Theory's strengths is its versatility. It works on both short-term and long-term charts. Start by analyzing a daily or weekly chart to get the bigger picture, then zoom in on shorter time frames, hourly or minute charts to identify specific entry and exit points. Number 3. Study corrective patterns to avoid losses. Many traders overlook corrective waves, but recognizing them can minimize losses. Learn to spot the primary waves. Corrective patterns can be tricky, but they often signal when to close positions and avoid losses. For instance, if the wave looks weak, it might indicate the end of the correction and the start of a new impulse wave. That's it for today, friends. We hope you learned something new and are ready to apply this knowledge in your future trades. Remember to like, subscribe, and hit that notification bell so you won't miss our next episode, in which we'll discuss even more useful trading tools. See you next time.